Everyone in property tells you the same thing. Land appreciates and buildings depreciate. So only buy houses. But what if that idea is actually costing you hundreds of thousands of dollars in missed capital growth? My name's Eddie Dilleen, and I own over 150 investment properties across Australia. And today I want to show you why that advice is outdated and what some of the best performing deals in my property portfolio actually were. And I'll even share a few real case studies where these types of properties doubled in value even faster than standalone houses in the exact same suburb. Now, there is three key things that I want to share with you today about how a property is also valued, right? And how it grows in value over time. The first thing I've written today down here is inflation. So I'm going to give you some real life figures. I recently bought a property in Sydney in the suburb of Guildford. It was a 2-bedroom, 1-bathroom, 1-car unit. And I bought it for only $379,000. We did a bulk deal transaction. It was a bank repossessed property. There was 8 units, and I bought one of the units, and 7 lucky clients bought the other units. Now, these units were worth easily $100,000 more. We got them at a bulk discounted price because it was a bank repossession, and we negotiated them in one line. And they ended up being only $379K a piece. What I think about when buying a unit of that price of $379, now the average median price for a unit in Guildford, I believe off the top of my head, is about $500,000 to $550,000. Now, it actually costs substantially more than $379,000 to build a unit. And this is because of inflation. As inflation inevitably goes up, and it always has and always will go up, inflation is just one of the things you cannot stop. But back when this property was built, the property is about 10 years old, they probably even back then paid $300,000 or more just for the actual build cost back then. Now, as an example, the average quote to build even just one individual unit within a block, or let's say you want to build 10 units, it's going to be probably minimum $450,000 at least, probably $500,000. So to rebuild this unit, it's going to be around $500K to rebuild it, but that's not including the land. You're probably into it for around $600,000 now in Sydney. Now, on top of that, want to add margin on there to actually make a profit. So what I think about is to build a unit brand new, to buy the land and build it, construct it, and then sell it for a profit. The price is essentially, for that example, it's probably going to have to be around $650,000 for a brand new unit. So this is a newer property as an example. I've just looked up one right here. 2-bedroom, 2-bath, 1-car apartment. They're selling now between $680,000 to $725,000. Let's say their average, you're going to have to be selling it for like $680,000, or in that example to $725,000, just to make $100,000 profit on selling that unit. That has to do with inflation going up over the years. And what that does is that the higher that those new properties end up being sold for and have to be built by, then the median unit price for that particular block ends up getting pushed up to $725,000 or $800,000 as an example. And what happens is then it drags up existing unit prices. This is just one example of how, a $379K property, it's worth, $470, but that'll get dragged up to $550. So while a unit might not have much land component, I believe it's very silly and very stupid to say that the building is going to decrease in value, because inflation makes replacement value increase over time. So that's why people's insurance policies on properties and houses and everything like that continue to inevitably go up with inflation. As an example, 30 to 40 years ago, you could build a house for maybe $10,000 or $20,000. But now, it's very hard to build a property for under $600,000 in terms of building costs. And if you're building a luxury home, then you're talking 2, 3, 4, 5 million, because affordability is another thing, right? One of the things I've noticed is that affordability always wins. The more people that can afford a particular price point, the more people are in that group, the higher the amount of potential growth that property and that location can have. Let's say, for example, a medium house price in a particular suburb is 1.5 million. But then let's say the median unit price is only $500,000. So it's a third of that amount. More people can afford a $500,000 property compared to a $1.5 million property. So because there's more people in, that to me has a better chance of going from $500K to $1 million than from the $1.5 million house going to $3 million median price. Now, before we get into the next point, if you're watching this and wondering how the hell I got to 157 properties so young, I actually wrote everything down. Literally the steps I followed to help you shortcut the entire process yourself. It's called 30 Properties Before 30, and you can grab it completely free using the link in the description. No fluff, just a real strategy that took me from absolutely broke teenager to a full-time property investor at the age of 33. The next point I want to talk to you about what impacts the value of a property is the actual income that property is bringing in. And I've noticed this over the years that someone will see more value in a property if a property has a higher lease amount. So as an example, let's say you find a property online for $500,000. It's very usual to see the average rental yield of being, 4% to 5%. The hypothetical question that I would ask yourself or anyone else out there is, let's say the average property in the area was $500K and it was renting out for $500 a week. So that gives it a 5.2% rental return. If that property was not rented for $500 a week, let's say as an example, it was rented for $1,000 a week. So instead of $500 per week, let's say now we've got a lease in place for $1,000 a week. Then the gross rental return would be 10% plus. The question I ask is, would you find that online? And the answer is most likely not. You wouldn't find that. Because the income of what a property has associated with it at the time is what people will be attracted to and see value in. So if a property was renting for $1,000 per week, as an example, then most likely they wouldn't be asking $500K for it. And that's because of the pure rental return. So they would probably jack up this price to, let's say, $700K or more. And then that would obviously deflate the rental yield. So if it was $1,000 a week times 52 divided by 700,000, then that makes the rental return 7.4%. And I've noticed this before, that where people that have owned properties, whether it's themselves, they've managed to get a very lucrative lease in place for, let's say, the next 12 months, and they put it online, a $400K property renting for $800 a week, which is a great return. It's like a 10% yield roughly, right? So income can affect the value of your property. If it's rented for too less, you can actually get it undervalued, or maybe you'd not get as high as offers when it comes to sell. And on the other side of it, if it's rented for very, very high, then when it comes time to sell, you'll often have more investors, as an example, look at that and be very attracted to it and be willing to offer more. It's another positive thing that adds to the sales pitch of that particular property in the marketing. It's not just the land that grows in value and makes the property valuable. It is a combination of the replacement value of that property and inflation pushing up the replacement cost. It's a combination of the income that's attached to that property, not just the land value. And it's a combination of the affordability, which again ties into inflation. And look, if you've been sitting on the fence wondering how to actually get started or scale your property portfolio to the next level, my team offer free discovery calls where we go over your goals and exactly where you're at now and help you map out a proper property portfolio plan. No pressure, no sales script, just real advice from real property investors who've actually done this before. Hit the link below if you're ready to take the next step. Another thing that can affect the value of a property, it's not just the size of the land. You can have things that affect the value of the property, such as zoning. You could have a bigger block of land on one side of the street. It could be worth less than a smaller block of land on the other side of the street because the other side of the street is maybe zoned for something different, such as has a higher building limit to that side of the street. So just because the land is bigger doesn't necessarily mean it's worth more. So back in 2019 and 2020, I was buying townhouses for clients and myself within the Logan market, and we were picking these up for $130,000. Now it's 2025, 5 years later. Those same townhouses are worth $450,000 to $500,000. They basically 4x'd in value over a 5-year period when they had very minimal land. Most of them had only 60, 70 square meters of land. Why is that? Was it the land that basically went up in value that much? It wasn't, because the houses didn't go up in value that much. But basically, I've noticed that the townhouse and units have actually gone up in a higher percentage of value than the house. And again, I've got videos, so watch the videos after this or check out the links in this description and you'll see examples where I give you the addresses of a unit or a townhouse versus a house, and the house has gone up but the unit's technically gone up more in a percentage value. So now you know why chasing land content and land value isn't the only way to build real wealth in property, because buying in the wrong location can wipe out all your gains, even if the strategy is solid. So check out this next video where I break down the 5 best cities in Australia in 2025, including one that is almost no one is talking about right now.